Hi. So today we'll be looking at a standard called as IAS 23 borrowing cost. Okay, this is one of the easiest standards that I would say in terms of your financial reporting. And in terms of weightage, how this should be tested in your financial reporting paper is maximum 2 marks, maximum, right? So I don't think you all need to spend more time in learning this concept, right? So it could be either tested in your section A for an MCQ, section B for an MCQ. And in case if your examiner feels that it is important, he can text you in your company accounts. That would be for another 2 mark adjustment. So maximum it lingers between 2 marks to 4 marks, right? Now jumping into the standard, before we start off, this standard, as I told, it's a relatively easiest one. So maximum your recording would be for less than an hour. Okay. Hopefully I'll watch it. If you all have any doubts, just WhatsApp me off. Okay. So now let's start. Okay. So you all know normally there is a tendency that businesses do take loans from any banks, right? They take loans from multiple banks, right? And they need to pay an interest on that. Okay. Say for an example, give me, let me change my pen color. Okay, it is okay. For an example, I'm running a business which is ABC, right? And I have taken a loan of 1 million at an interest rate of 5%, right, per annum. So what I would do, I need to pay, eventually I need to pay an interest expense, right? I will be paying 50,000, right? I'll be paying 50,000, right? In my company's books, I'll be recording it under finance expenses under my P&L. That's the general norm, right? That's what we have learned so far. Okay. But now what happened was IAS 23, which was developed by IASB, International Accounting Standard Board, what they did was they are telling if a business takes a loan, right? If a business takes a loan, right? And that loan amount is utilized to construct a building, right? If you're taking a loan, if you're taking a particular amount of loan, and that entire amount is used to build a building, right? I'm not telling you to buy a brand new building. I want you to construct the building. If you're planning on constructing it from the foundation, then you do not need to show it as your financial cost, or you do not need to show it under your financial expenditure in your P&L. What you would do is you can simply capitalize this interest expense, right? Another name for capitalizing the interest expense is, what you can do is you can simply show it under your cost of the asset, right? This will be simply shown under your cost of the asset. Okay. This will be simply shown under your cost of the assets. Yes, under non-current assets, you know, in your statement of financial position, in your statement of financial position, under non-current assets, you will be recording your assets at cost, right? Cost minus accumulated depreciation equals carrying value. In that, you can show this 50,000. This is the treatment. If you are taking the loan and that entire loan is used to construct a building, office building for business purposes, right? Just because you take a loan and you build up your house, or just because you take a loan and you build up a house and give it to rent, that doesn't work. You need to build a building utilizing that loan that was obtained from the bank, and that amount, that building has to be used for your business purposes only. Then you can capitalize this. Then you can capitalize this entire cost. Okay. Now here it is, another one. Now this is not a deliberate overstatement of asset and understatement of profit or loss. Right? That you all need to understand. That you all need to understand. Under prudence concept, hopefully I'll remember. Under prudence concept, hopefully I'll remember that you cannot overstate an asset or you cannot understate an expense. That is against the law. Okay. This is not an overstatement or understatement. This is simply what the standard tells us. Hi, sorry. There was a small internet issue from my side. Okay. Now, see here. Normally during your financial reporting or SBR, you're not supposed to write or you're not supposed to memorize the definition, right? I've just given it for the purpose of learning. Okay. In terms of definition, what does IAS 23 says is, right? You can capitalize the loan interest. You can capitalize the loan interest, right? If the loan was invested in a qualifying asset. If the loan was invested in a qualifying asset. Now you all might be thinking, what is the meaning of a qualifying asset? Well, it's nothing much, it's nothing new that we know. Let's see what they mean. Okay. Qualifying asset means the asset that takes substantial amount of time. Okay. So what do you mean by substantial amount of time is, see, let us take the building itself, construction of a building. Do you all think that I could construct a building within 6 months, 8 months, 1 year? No, right? It takes a longer period of time. It takes more than 2 years to construct about at least minimum 3 to 5 floors building, right? So that is one of the example of your qualifying asset, right? And that I told you, always remember that building, that constructed building must be solely used for your business related purposes, right? Second, second example of a qualifying asset would be inventory. Do you all remember now it's not all the inventories. There are some specific inventories. Now see, you take production of whiskey, right? The alcohol that you all drink, you take the production of whiskey. You go and see, I guess you have to watch Peaky Blinders and stuff. You all see that production of whiskey takes about 10, 20 years because that particular ingredient has to, has to dissolve, something of that sort. That's into the fermentation, something that has to dissolve. So that would take about 10 years. So that is also another qualifying asset. Okay. And number three, you call something as bearer plants. Bearer plants are like, for example, you all know, right? The table that you all this one, the doors, the timber, right? Do you all think that you could easily grow a tree and you could easily cut off a piece of chunk? No, right? Timber takes about 10 years, 20, 15 years to grow. After all, you could cut it off, saw it, and make doors or furniture, whatever you want. Okay. So these three are the assets in terms of qualifying assets. Okay. If in your IAS 23. Okay. But let me tell you all, majority of the times, always 100%, you all will be only tested with construction of a building for business use. This inventory, this bearer plans will not be tested in your IAS 23. Yeah, just you all just need to know the definition. That is more than enough. You all just need to know the definition and some of the examples. Okay. So what do you all mean by qualifying asset? Qualifying asset is an asset that takes substantial amount of time to sell it or to use it, right? Yes, to sell it or to use it. It takes a longer period of time. You cannot build a building within 6 months. It's very hard to build a building. Okay. 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 So this is also done. Okay. Now this is another theory, which are not qualifying assets. I told her, right? I told her, right? There are some inventories. I told there are some inventories. Now, for example, you can take water bottles, soap, biscuits. These and all don't take a substantial amount of time. You can produce a biscuit within a day. You can produce a biscuit within 2 weeks. Soap also same. Water bottle, when you all are packaging, when you're bottling it, it just takes about half a day to package it if you all are doing an entire job at once. Right? So that is not a qualifying asset. Number two, readily purchased asset. Now, what does readily purchased asset? I told you, if you all need, if you all need to capitalize the interest of the loan, right? That has to be a construction building. If you all buy a building that was already constructed or a brand new building, you cannot capitalize. You cannot capitalize. You see, readily purchased asset means that asset was not constructed. You are not going to construct. It's already constructed by another person and you are just buying it, right? So that is not allowed. So this would be in terms of definition and the explanation of IAS 23. Okay, now let's look at an example where we will be even more understanding in further of how we can treat IAS 23 borrowing costs. Okay, look at this. Okay, Peter owns a business, right? He has taken a loan of $80,000 for how many years? For 5 years, right? At a rate of 10% per annum, right? So until this purple line, can you see here this purple line? Our brain is automatically programmed to think that this is a basic loan. Just treat it as a finance cost, right? Until we read off what was the intention of taking this loan. Reading on, this loan was taken to construct a new factory. Now think, are they buying a existing factory or are they buying to construct a factory? So that loan was specifically only taken to construct a new factory. So this would fall under qualifying asset, right? And they all know the time period to what we call build this constructed new factory takes about minimum 2 or 3 years. So therefore, it's a substantial amount of period, right? With the aim of increasing the production units. So my question would be is how to treat this? Can we capitalize it? Right? That would be my question. Can we capitalize this? Okay. So 80,000 into 10%, which is 8,000 per year, right? So this 8,000 cost can be capitalized. Why? This loan was taken to construct building or factory. It was taken to construct a factory. For our personal use, no. It's for business use. Point number one, right? And number two, is that asset a qualifying asset? Yes, it is. Why? Because we are not buying a ready-made factory. We are buying a newly constructed factory. That is why the loan was taken. So that also is there, right? And you know how long it takes to construct a factory, right? It takes about substantial period of time. Okay. Since all these conditions are being met, yes, you are free to capitalize. How will you present it in your financial statements? Will you go and show it under financial cost in your P&L? No. You will go to your non-current assets. Since this is a business utilized factory, you will be showing it under PP, right? You will be showing it under PP at 8,000 cost, right? 8,000 cost means considering there are no other costs. Purchase price, I don't know. How much was the installation, I don't know. None of those I know. Okay, but this will be capitalized, right? So this is how you do. Now, don't expect these kind of questions to come in your exam, right? This is only just for illustrative and explanatory purposes alone. Okay. Okay. Now, these type of questions you will be tested, and I told you right initially when we started off the lectures, you will get a 2-mark question. Well, this would be one of the type of 2-mark questions that you all can expect to get. Okay. Okay. Now, before I move into your accounting, let me tell you all too. So, when you're taking a loan, right? When a business is taking a loan, what happens is normally you can take it from one particular person or from one particular bank. That is situation number one. Situation number two is there are real life scenarios where one particular bank will not be approached. There will be multiple banks that will approach to collect a larger sum of loan, right? So that is situation number two, which we'll be discussing later. Okay. So let us look at this question where we are only taking the loan from one person. Okay. So before you read off the paragraph, let us read off what the requirement they want exactly. Calculate the amount of interest to be capitalized as at 31st December 2008. So always when I get these kind of questions, what I do is I tend to draw a timeline If you all want during your exams, if you all are able to save in time, then you all can do this. But otherwise, find an easiest approach that you all are able to finish it off. Okay. So 31st is the year end. Then obviously a year beginning would have been 1st January 2008. Okay. Okay. Wilson received 18 million, right, on 5% loan note on 1st January 2008 to construct a new factory. Right. He's planning on constructing a new factory. Okay. When did he receive the loan? He has received this loan on 1st January of 18 million at 5% per annum. Right. So that I put it in one corner. Reading on. As funds were not all required immediately, Wilson invested 6 million in 2% bonds until 31st May 2008. So what he's doing is, even though he took that 18 million on 1st January, that entire sum was not needed. So what he did, he took out of 18 million, 6 million and invested it in bonds. Obviously, no, when you invest in bonds, you'll get interest income, right? But do remember, he is only getting interest income from 1st January to 31st May. That's about 5 months, right? Okay, we'll be looking at interest income later. Okay. Construction of factory began on 1st March and was completed on 31st December 2008. Now, this point is the one that you all need to think about. This point is the one that you all need to think about. Okay. So, he took the loan on 1st January, right? He started construction. Can you all see here? Consider this ugly thing as your building. He started construction on 1st March 2008, right? And when did he end the construction? Construction was ended on end of construction, right? He ended his construction on 31st December 2008. So that means March, April, May, June, July, August, September, October, November, December. For 10 months, your interest can be capitalized. Your interest expense can be capitalized. Why? Because any loan interest that was taken during the construction period or any loan interest that is being charged during your construction period can be capitalized, right? So what you'll do is, you see, how much is the loan amount? First of all, let me change my pen color. Your loan amount is 18 million, right? At 5%. You will be charged 900,000 per year, right? But now you all need to think, will I be taking the entire 900,000 to my PNL, or do I need to send at least a certain amount towards my balance sheet? Okay. So we know that we are allowed to capitalize the asset. Capitalize means we can show under our cost in our balance sheet of the asset, right? How many months can we capitalize? How many months? 10 months. Why 10 months? Again, I'm repeating myself. You started off your construction on 1st March 2008. You ended off your construction on 31st December 2008. So you can capitalize any interest expense from your beginning of the construction to the end of the construction, right? Not any period before this. Can you see? This period, you cannot capitalize your interest expense. Cannot capitalize interest expense. And anything after 31st December 2008, that also I'll add it. Yeah, that as well. Any period after here. Any period after here, you cannot capitalize. You only can capitalize during your construction period only, right? Always try to understand you only can capitalize during your construction period only. Anything before that, you cannot capitalize, treat it as P&L. Anything after your construction period, treat it as P&L. It will come under your interest expense, right? Okay. So 900,000 was your loan per year, interest expense on loan, right? But we are allowed to capitalize for 10 months. We are allowed to capitalize for 10 months. So that means 750,000 can be showed under your statement of financial position under property, plant, and equipment. Right? So you all might be thinking, out of 900,000, 750,000 will be shown under statement of financial position. What would happen to the remaining 150,000 balance? What would happen to 150,000 balance? Can you see here? This 150,000 guys, this 150,000 was generated during which period? Was generated during which period? From this part to this part. Now see where you're standing from 1st January to 1st March. Did you all start constructing the building? No, right? You all did not start constructing the building. So then, since you all have not started constructing the building, you cannot capitalize. You cannot capitalize. So what would be the treatment of 150,000? What would be treatment of 150,000? Simply expense it to your P&L. Or simply you can tell finance cost or expense. This is how we do interest expense related question. Okay. We only capitalize interest expense. When will we capitalize? During our construction beginning to construction end. Anything before that is not capitalized, directly charged to your P&L. Anything after a construction period is also not capitalized. It is directly charged to your P&L. Right? So here, see, I've given you some notes. You see? Always only interest expense can be capitalized. Right? Only your interest expense can be capitalized. Now, the reason why I'm telling you all interest expense only can be capitalized because there are multiple questions which give you all interest income as well. Right? We will all be looking into that in a bit. Be patient. Okay. Number 2. Only capitalization occurs during construction period. Right? Not anytime before or anytime after. Only during construction period, which is this period. Only during this time, you can capitalize your interest expense if the loan is taken to construct a new building or a factory. Okay. Okay. Now coming into the final part. Do you all remember? That I told you all? Can you see here? As the funds were not fully required, what Wilson did, he took 6 million at 2% rate and he went and invested. When you're investing, you will get an interest income. Okay, you'll be getting an interest income. Okay. Now, when did he start investing? He started investing on 1st January. He directly took that loan and he invested. Till when? Till this part. Now look at my purple line. Okay, just look at my purple line. Look at my purple line. Look at my purple line. Can you see here? Can you see here? For 5 months, he has invested. So obviously, he'll be generating an interest income for 5 months. But now again, we need to be careful. Can we take the entire 5 months into P&L or do we need to bifurcate? That we need to look into. Why? Because see, our construction starts on 1st March, right? Which is in between 1st January 2008, the loan taken date, and 31st May 2008, when you ended the bond, when the investment ended, right? So let's look into that one by one. Okay. So obviously, 5 months is the total loan. 5 months is the total loan. sorry, total investment is for 5 months, right? You took 6 million, you invested 6 million at 2% coupon rate, right? So you will be getting 50,000, 50,000. You'll be getting 50,000. Now you need to understand, do I need to take the entire 50,000 and show it under interest income, or do I need to bifurcate it? Do I need to allocate it properly? I would say you need to allocate. Can you see here? Now again going into the graph. Can you see here? From 1st January, from 1st January, I'm running out of colors. Okay, it is. From 1st January, look at my blue line, okay? From 1st January to 1st March, okay? From 1st January to 1st March, it is known as non-construction period, right? So that anything that is generated during that time, you can directly take it to your P&L. Whether it can be your interest income, whether it can be your interest expense, you can directly take it to your P&L, right? So 1st January, 1st February, 1st March, sorry, 1st January and 1st February, right? Because you're starting on construction on 1st March, right? So the first 2 months is your non-construction period. So that interest income that is generated during that period of 2 months, interest income that is generated during that period of 2 months, what you can do is you can take to your profit or loss. You can take it to your profit or loss, right? Then you all might be thinking, what about the remaining 3 months? What about the remaining 3 months? Do I go and capitalize it? Do I show it under my cost in my balance sheet? I would say no, never do that. You only, here see, I'm marking it again. Here see, we never capitalize interest income under IAS 23. We net off. Give me a minute. We net off. Okay, so I'll show you how we net it off. I'll show you how it net it off. So from 1st March, can you see here? Can you see here? From 1st March, look at my red color line, okay? From 1st March to 31st May. This is during construction period. So automatically our brain would tend to think, okay, I capitalize interest expense also. No, I'll try to capitalize this also. Why? Because it's during construction period. I would say your foundation is gone wrong. We will only capitalize interest expense during our construction period. If our interest income falls during construction period, we will not capitalize it. Okay, we will not capitalize it at all. So what do I need to do? What do I need to do? Can you see here from 1st March to 31st May? That is March, April, May. That's 3 months. Okay, that's 3 months. Right? That is 3 months. So 6 million was the investment at 2% per rate. 3 months is your interest income. That 30K, what I will do is, that 30K, here see, what I'll do is, look at this part. The interesting best part. In my balance sheet, I'll go to my balance sheet. How much will I capitalize in terms of interest expense? How much will I be capitalizing in terms of interest expense? Look at this. How much will I be capitalizing? I can capitalize 750,000 of interest expense. Why? Because it arose during my construction period, right? So I can capitalize that. That I have 100% permission, right? I'll be capitalizing 750,000. This is fine, right? Do you all remember that I generated an interest income during my construction period and we were thinking what we could do, what we could do? What I'll do is I'll be netting it off. I'll be deducting it. I'll be deducting it. Interest income earning during construction period will be deducted, right? I'll be deducting it. So finally, I will arrive at a cost of capitalization. Cost to capitalize 720,000. So this 720,000 only will be the cost you will need to show in your statement of financial position under non-current asset PP. Okay. So that is in terms of your balance sheet. That is in terms of your balance sheet. Now, finally, I know I dragged it a bit, but let's try to finish it off. In terms of your balance sheet, do you all remember? Do you all remember? You generated an interest income, right? But 2 months, 2 months, which was before construction, you call it another word, pre-construction. 2 months. That interest income can be taken into your P&L. That's what I have plus it. Can you remember? 20,000. Here it is. This fellow. 20,000. It was before construction, pre-construction. That interest income, you can directly take it to your P&L under your other income category, right? What about the interest expense that was generated during your non-construction period? During your non-construction period. What about this fellow? What about this fellow? What do I do with this fellow? What do I do with this fellow? He also, I can show it under an expense, under financial expenses. Can you see here? I'll be showing him under my financial expenses under negative balance, right? So this is how we present and this is how we do. Okay, this is how we present and this is how we do in terms of your IAS 23. Okay, let's read this note and we are done with this part for a bit. Okay, when we are capitalizing the interest expense, when we are capitalizing the interest expense, we need to deduct the income. We need to deduct the income that was earned during construction period. That is known as net capitalization. Yeah, you net it off. Can you see here? We netted it off. We netted it off. Can you see here? We netted this fellow off. Okay. So it's quite simple, guys. I know I dragged it a bit. Let me give you all a summary. Let me give you all a summary. In terms of interest expense alone, if that interest expense was taken to build off a new construction factory, what you need to do is simple. What you need to do is quite simple. You will take any interest expense that is generated during your construction period, you can capitalize it, right? Any interest expense that is generated before your construction period or after your construction period, you need to simply take it to your profit or loss under financial cost. That is point number one. Point number two, you all might be thinking, what do I do with my interest income? That also you need to do like this. If it's interest income, okay, if it's before your construction period, you can directly take that interest income to your profit or loss and show it under other income. If it's after your construction period also, you can directly take it to your profit or loss under other income. Now, you might be having a question. What would I do if my interest income is generated during my construction period? Right? During that period, what we will do is simple. We will net it off. We will net it off. How will we net it off? From the interest expense that is being capitalized, we will deduct the interest income that is generated during your construction period. So what I want to do is, this is since it's new, what I want you all to do is pause it, rewatch it, and then try to understand the concept, and then jump into your Kaplan and BP, right? Okay. So we are done with that part. We are done with that part. Now, this part might be complicating or it might be new for most of the people. If you all watch it in a slow paced manner, you all be able to understand, right? It's a very easy one. You all just don't need to complicate. Okay, moving on to a final one. Moving on to a final one. I guess we have two slides. Okay, final. Now, this is an easy one. This is an easy peasy one. Now, see, I told you, right? This situation number two. When you all take loan from multiple people, how do you do accounting? Okay, see, if an entity, see what's happening. They have taken 10 million. at 6% loan note. And after that, they have taken a 2 million of 8% loan, right? So they have taken from two companies. Now you might be thinking, which rate am I supposed to be using? Am I supposed to use 6% or am I supposed to use 8%? Then that doubt would be arising. What you need to do is simply use the average method. Simply use the average method. Logical, right? You are taking two or three companies from two or three companies, you are taking loans at different rates. So you need to understand which rate am I supposed to use. We will come and take it at our average method, right? So this is how we calculate average method. You know how much loan was taken. This was taken by 10 million was taken at 6%, right? 10 million was taken at 6%. So how much loan you need to pay? How much you need to pay interest? You'll be paying 600,000. So that is 10 million into 6% is equivalent to 600,000. Write it down. Write it down. After that, you took again 2 million of loan at 8%, right? So you need to pay 160,000. Write that also down. After that, add these two fellows up. You will get the total interest that you need to pay, right? I'll write this interest to be paid, right? But now we need to understand this interest is at multiple different rates, right? So we need to come at something called as the average rate, right? And now how much we have taken in total? How much we have taken in total? We have taken 12 million, right? So it's quite simple, guys. 760,000 is my interest expense divided by 12. You will be coming at an average rate of 6.33%. You will be coming at an average rate of 6.33%. This is how you find out your average rate. This is how you find out the average rate. Okay. Now again, I want you to pause off your recording for a minute and then watch. And now we are going to do a question from Kaplan to make our mind even more understandable. Right? Okay. Look at this question. Look at this question. Look at this question. During the current year, an entity had in place 1 million of 6% loan, right? So they have taken 1 million at 6% rate. So your interest expense, INT expense, is at 60,000, right? And after they took 2 million at 9%. So 2 million at 9% is equivalent to 180,000. So your total interest expense is 240,000, right? And your total amount that is being borrowed is 3 million. So you need to find out when you're taking from different banking rates, you need to find out your average rate, right? How do you find out average rate? Simply 240K divided by 3 million. Wait, I'll show it. Here it is. That is 240,000 divided by 3 million. You will be arriving at an average rate of 8%. Now you all might be thinking, what do I do with this 8%? You all might be thinking, what do I do with this 8%? It's quite simple. It constructed a new factory which cost 600,000. And this was funded out of the existing loan of finance. This was financed through these two loans. This was financed through these two loans. So 600,000 was the cost. 600,000 was the cost. So what I'll do is, look at this. What I'll do is, 600 was my cost, right? And 8% is my average rate, right? 8% is my average rate. Now, you all need to again remember, we will only capitalize our interest expense during construction period only, right? Nothing before construction period, nothing after construction period, only during construction period. So can you see here? The factory took 8 months to complete. So that means we will only be capitalizing for 8 months. right? So 600,000 into 8% per year, you will be getting a yearly rate that you need to divide by 8. You need to multiply it by 8 months. Why? Because this is your construction period, right? So therefore, you would be arriving at a 32,000 cost. This 32,000 can be capitalized. This can be capitalized. So I'll show you how do you capitalize it as well. Let me show you. Go to your non-current asset in your balance sheet. Under PPE, you will be showing 32,000. This is how you present your financial statement, right? So we have done with our accounting. We are done with our accounting. So it's quite simple. I would say the average method is quite easy, right? This you all need to look into it because why? I do not find out this part hard, right? As long as you're grabbing the concept, right? Just watch it again once at say a normal spaced manner, you'll be able to understand. Okay. Now a question would come: when will I cease capitalization? Right? When will I stop capitalization? One, I told you will only capitalize during your construction period. Right? Anything after your construction period, you cannot capitalize. So that means what I mean indirectly is if you finish off your construction, if the building is complete, if you have constructed the building 100%, right? If your building is complete, then obviously there is no point of capitalizing interest expense, right? Only your interest expense will be capitalized if you are constructing the building during the construction period only. Anything before that, you take it to P&L. Anything after that also, you take it to P&L, right? So during this time, if it's completed, you cannot capitalize, right? Or number two, if construction is suspended for a longer time, I have experienced this in my personal life, right? So normally when you're constructing a building, right? Normally your laborers and the manager will be having multiple problems. They are called disputes. It can be money problem, it can be raw material problem, it can be corona, any of those sort. Due to that, your construction might be held at pending in a pending manner, right? So then if it's suspended for a very longer time, so that means you are not going to construct that company for another 100 years. For an uncertain amount of time, you're not going to construct. So then you cannot capitalize. You cannot capitalize. So I'm writing a note here. Let me write a note here. Let me write a note here. Interest expense cannot be capitalized before construction period or after construction period. Right? You will only capitalize it during your construction period only. Right? So what would I do? If I cannot capitalize it, what would I do? What would I do if I cannot capitalize? I simply take it to my P&L under finance cost or slash expense. Right? Finance cost or finance expense. This is it in terms of the interest expense. Right? Let me write another note. Let me write another note. I'm really sorry if I'm wasting your time, but as I planned, hopefully this I will be able to upload it, the recording, and hopefully it goes for maximum less than 1 hour. Okay. Interest income. Interest income. If it's pre-construction period, what would I do? Take it to my P&L, show it under other income. If it is during construction period, what you will do is you will net it off or remove from PPE. Is what you need to do. Right? Don't worry. We have questions from Kaplan, we have questions from BPP, we have questions from Study Hub, right? Which is readily available to access. And when we are doing it, we'll be understanding even more further. right? So I guess this is more than enough, more than sufficient for you all to do any question that is related to your IAS 23 uh, borrowing cost, right? Final question and we're done for the day. Final question and we're done for the day. Uh, the requirement. Calculate the total amount to be included at cost in PPE at 31st December. So what they're asking is simple. What they're asking is simple. Now you all know, right? Under non-current asset, I am going to show under my PPE. Why PPE? Because it's used for business purposes, right? How much do I need to show? How much do I need to show? Right? So now this is a complete package of question. This is a complete package of question. Even though the paragraph might be looking large enough, I would say the content is less. Okay, let me read. On 1st January, Changeco began construction of a supermarket, right? So on 1st January, he began construction. Fine. He purchased the site at 25 million. Now you all need to know 25 million will be added to your cost. Why? Let me change my pen. Just give me a minute. Why? Because this is your cost. Your purchase price is an allowable cost. You all need to understand that, right? This is your IAS 16. You all would have learned what cost will be, what are the expenses that can be shown under a cost in PPE and what cannot be learned shown under a cost of PPE, right? So this is your basic IAS 16, which you are learned in your foundation and your FR, right? So purchase price can be shown under your cost, right? Number two, the construction of building cost was 9 million. So obviously, right, the materials, the labor, and other other overheads, that also can be shown under your cost, right? And the fixture and fittings of 6 million. So that also can be shown under your cost. Why? Obviously, if you are if you are building a supermarket, you need to have racks. You need to have what you call those. You need to have escalators. You need to have lifts. All of those are furnitures and fittings. Those are inbuilt, right? Those are inbuilt. Without that, your business cannot function, right? So you need to put that also under cost. Now comes the best part. Now comes the best part. Now comes the best part. I can show my interest capitalization as well under my cost. So far, what we've been doing, all the remaining two questions that we learned so far is we only had this particular part. We directly went and took this and entered it into our balance sheet, right? So let's see how we're going to do it. Let's see how we are going to do this. They're telling the useful life is 40 years. I guess that's not relevant at all because we are not finding depreciation. This is something related to IAS 23, not PPE 16. Right? So that's irrelevant. Useful life is irrelevant. Okay. So my construction, I started on first. Okay, let me read this. The construction of supermarket was completed on 30th September 2005. I started my construction on January. I completed on 30th September. So that's about 9 months, I believe. So you all know that look at my purple marker. Look at my purple marker. You all know any interest expense that is generated during your construction period can be capitalized. So you'll be capitalizing for 9 months. You'll be capitalizing for 9 months. So how much will you be capitalizing? See, you borrowed 40 million on 1st January in order to finance this project. The loan carried an interest at 10% per annum, right? So how much will I be capitalizing? How much will I be capitalizing? I took the loan at 40 million. I had to pay 10% per annum, but I will not be capitalizing the entire amount. I'll be only capitalizing for 9 months. Why? Because this is my construction period. Simple as that, right? So this 43 million, your total final cost, this 43 million, you will be showing under your PPE. Sorry, give me a minute. 43 million. You'll be showing under your non-current asset, property, plant, and equipment. You'll be showing 43 million at cost. So this is cost. We don't know accumulated depreciation, and we'll show up our carrying value. This is all it in terms of IAS 23. Okay, this is all it in terms of IAS 23. Final point, and my answer day. Now, what I was planning on telling is normally students will get confused. Students will get confused. Why will they get confused? Look at this part, okay? Look at this part. Look at this part. The construction was completed on 30th September 2005, right? And it was bought into use on 1st January 2006. Now, this is not a tricky part that examiner is trying to test you on. He just wants to see whether you all have the knowledge or not, right? Always, always look at when the construction was completed, right? Do not ever go and look into when the asset was bought into use, right? That is my note. That is my note. Always look at the date when your construction was completed. Never go and look into when it was brought into use. Never, right? Because IAS 23 specifies you only need to look into construction period, which is from the date of construction to the date when the construction ends, not when your construction is brought into use, right? This brought into use will be used when you're calculating depreciation under PP 16, right? That you all will look into your IAS 16 recordings and you all be able to understand, all right? So this is it in terms of IAS 23. If you all have any doubts, if you all have any queries, just reach out. I'll be able to respond. Thank you for joining. See you all again.